And welcome out to the Tackle Trading Halftime Report. This is Coach Cody. We have myself, Coach Noah, and Coach Matt on today. And first of all, if you're here every day getting our intake on what's going on in the markets have been kind of crazy the past 2 days, set a few records in the distance that they dropped, the percentage. Make sure that you're subscribed to our channel so you know the second that we're going live every single time. And if this is one of your first times finding our channel and our video and our halftime report, give us a like. Give us a dislike if you don't like us. Just let us know some feedback on what you're enjoying with what we're giving, how the market's going, our intake, how we could possibly be helping you in your portfolio or giving you a little bit of understanding of this crazy market that has been this week. But with that, guys, I'm going to go ahead and just pass it off to Matt. Matt, what's going on in the markets today?
The same thing that's going on in the markets today that's been going on the past, couple days. Just a lot of coronavirus news and so on and so forth. And I don't want to spend too much time kind of going over the news. Just want to give a really quick update on kind of just the high level news. And this is, shout out to Zero Hedge, free Zero Hedge Twitter. But shout out to Zero Hedge for putting this summary together. Number one, CDC reports 6 new cases among Americans. Iran death toll hits 19. Brazil confirms its first case in South America. France confirms the second death. Tokyo pushes back against Tokyo Games cancellation. That's an interesting one with the Olympics coming up in Tokyo here in just a few months from now. Greece has also confirmed its first case. Two massive stimulus programs kind of happened overnight. Germany unleashes fiscal stimulus after confirming new cases. And Hong Kong specifically put out, I think it was like a $15.6 billion making it rain with helicopters, cash just giving it to people. I believe it works out to about $1,200, obviously US dollars priced in Hong Kong dollars, but about $1,200 US dollars to every citizen above 18 years old. They're trying to spark a little bit of spending there, I think, in Hong Kong. The Dems, also Democrats on Congress, they released their fiscal stimulus package to combat the coronavirus. And unlike Trump put in, I think his plan was about $1.5 to $2 billion. Dems have about an $8.5 billion package, and the CDC has been woefully underfunded in this situation. So we'll see what Congress comes up with the congressional act to how they're going to combat the rapid expansion and the fear that is growing regarding the corona. Kuwait, Iraq, Bahrain also confirmed new cases. Pakistan confirms
Matt's got the coronavirus.
Cases.
Oh no!
Oh no!
Hey, shut it down. Upper respiratory. That's more common cold. Listen, I've done my homework.
All right, you've already been on WebMD and Googled your symptoms.
Hey, listen, upper respiratory, you don't have to worry. It's lower respiratory you have to worry. I've done my research. Italy confirms its 12th death, and South Korea cases soar above 1,200 as government begins testing 200,000 patients, and Brazil confirms the infected patient came from plane from Paris. Thank you, Zero Hedge. And once again, hashtag free Zero Hedge. But that's kind of the high level news here today. And, woke up this morning and, the news was markets trying to recover. And my first thought was, no, they're not. It's just it's a stall. No, from a technical perspective in the face of the news, and I'll turn it back over to Cody here in a second.
So what's funny, guys, is before we started, Matt was like, all right, Noah, you screen share it, and Cody, you'll host. I was like, Matt, every time I'm the host, it takes less than a minute before you take that over from me. When I try to play Tim's role and Tim's not here,
I have a control problem, Cody.
Matt just takes it. He just starts taking over control. It's like, all right, Matt, you go ahead and direct the conversation. I'll just sit back and trade my account. And
my control problems are nothing new. but I am going to throw it to Noah, and then Cody, you take back over. Noah, just give us a technical breakdown here. What's going on?
And first thing first, just kind of look at it from a daily perspective, and you look at again, we had a couple big monstrous candles down, and you can see a slowing momentum right here, but just the distance between the bottoms of the candles, it's getting closer. And even though you still have a lower low and today's high is lower, so by all signs, you're still in a downtrend. One green candle does not a reversal make, but you get down into an intraday chart, and you can see the slowdown here, and you can see where you did get one break of resistance. And you notice, Matt, I got a couple of random trend lines drawn on my chart in conjunction with those moving averages. I'm watching to see if we can put in a higher low here and maybe a break to a new high, violate the 50-period moving average intraday. That's on an hourly time frame. But at this point in time, you're still, the overall trend is down. You still have a lower low, lower low, lower high, lower low, and this could end up just being a lower high, and it could end up breaking right through 3,100 and run down next, to the next zone. But if we do see, a little bit more boldness come in from the buyers, that you might see a day or two up, and then I would be watching out for the 3,200 zone for the market to bump its head on, because that's the old support, and that's a price level the market's going to maybe retest if we see it able to take out today's high.
So guys, I follow many different headlines and things. Going into today, I had plenty of people, Twitter, some major news outlets, different websites, saying, we've dropped pretty precipitously over the past 2 days. We're probably going to get a recovery tomorrow. Were y'all expecting a sharp recovery today, or are you expecting exactly what we're seeing, which is a very volatile doji type day where the market's trying to figure out what's happening? What were you expecting coming into today, Matt?
Honestly, I in these types of moments, I don't want to try to predict what is going to happen. I want to read with my eyes. I was kind of expecting, after 2 big harsh down days with the Dow Jones sitting on the 200-day moving average, to have a little bit of hesitation, to give it a little bit of a room to breathe. Sometimes when the market volatility expands so quickly, it just becomes an emotional nightmare for a lot of people to a certain extent. And so I was expecting a little bit of hesitation, but even though the candle today is kind of a slowing momentum candle, if you go to the Dow Jones real quick, Noah, the range on the candle, especially in the Dow, is still really volatile. So even though we do have that slowing momentum candle, and the lows, Noah, actually, obviously confirm the lows are kind of contracting, but they're still lower lows. And I'll just say, once again, I've said it many times, slowing momentum does not mean increasing momentum for the other side.
No,
and
it does not guarantee a reversal by any means.
No, but like I said yesterday, and like I said on Twitter last night, I do think the next 24 hours, coming throughout the European markets, the Asian markets, the US markets, and then really kind of coming into that next night with the Asian markets is a really important area in the market, just given the fact that we are sitting on the 200-day moving average on the S&P 500. And if this fear does get out of control, it can, it can spiral to a certain extent. So I was expecting a little bit of hesitation, but the range on the candle is still extremely volatile.
So with a day like today, if you're in pain, what would you tell our students? How do you approach a day like today after 2 days down, and assuming that there are some students and traders out there feeling some pain right now? How do you approach it? Is it, we're at the bottom, we're sitting on the 200 period moving average.
If you're in pain as a trader, you should be in cash, because you're just going to be emotional and chase the dragon and compound bad mistakes. So I would say if the coronavirus is causing you some degree of any emotion in any capacity, you probably shouldn't be trading in that environment. That's what I would say.
So you think, so with positions that are still open, should they move to cash now?
Well, it depends on what positions. If you're in any bullish swing trades, you're stopped out already. So that's number one. Yeah. Bearish trades have been really, really, really solid. We talked, yesterday about that, trailing those stop losses on some of those bearish trades. Absolutely 100%. Yeah, and on short-term bullish trades, you're already out. The concern I think some people have in the market, especially with people who like to, stack positive theta, is in an environment like this, those bull put spreads get beat up pretty good. And Noah, how would you go about, if you're setting in some bull put spreads, right, on either the Russell or the S&P or, Amazon or whatever stock you like selling bull put spreads on, how would you approach, those? Because a lot of those are in the money right now.
Well, I'll tell you what, this is a good opportunity for me to pitch the Tackle 25 mastermind group tonight, and have you come to that tonight so we can give you a little bit more detail on how to manage the downside to some of those positions. We'll be talking about, how to manage covered calls and naked puts. We'll even throw in some credit spreads and just talk about how to manage the risk on those and what to do. Now, that being said, one of the first things I do, Matt, is I throw a bear call spread on it. Mm-hmm. And that doesn't get rid of the problem, but what it does do is it can neutralize your delta a little bit, and it can give you a little breathing room to relax. And because that's where I think people will find themselves in some acute pain on those, and they end up making rash decisions. And the biggest problem I find is where the stock's still above the strike price, and you're still in that zone where you can win on the trade, but you're feeling the pain from the drawdown, and you start to hope that the market rallies. You start to hope that it recovers, and you need to have a plan.
But hope's not a strategy.
Hope is not a strategy, but doesn't stop people from doing so. The big thing is you just can't let things like credit spreads go and stay below the strike price. If at any point in time it's trading below your short put strike, you're in the place where pain happens and doesn't recover very well.
So
and
you're telling me we should adjust the position before it hits the strike price?
Well, if you can, but sometimes when the market moves really fast and you see things gap overnight, you don't really get a chance to do that, right?
Yeah.
So that's where I always come back to from the outset, position size to risk. And I always tell people to look at that risk graph and position size that spread down to the strike price and imagine it gap down. Imagine that it did that so you understand how much pain it would cause. And then position size to the point where it doesn't make you cry. Because the minute you're under stress and duress in a trade, I think your ability to make coherent, intelligent decisions that are, again, not driven by your stress, really, really drops. And that's a very clear thing that we learn about how our brains work. Is it's easier to make those decisions in advance, and it's much easier to rip the Band-Aid off if you haven't exceeded like your big pain thresholds. So that goes back to portfolio design. But then, what do you do when it's in that situation? That's a pretty complex answer because there's lots of different things you can do. And for me, it's always like a case by case scenario. Like I have to look at it. I have to model out the idea of an adjustment and see if it works, because there's no one size fits all management I've found over the years. Because sometimes, one strategy or management repair works beautifully, and other times it won't work at all because the pricing's not there, the premiums, the bid ask spreads are too wide, et cetera, et cetera.
Well,
yeah.
Yeah, and one thing I'll say to that is when you're selling like a bull put spread and you see the volatility just explode like we've seen over the course of the last couple of days, you got a problem with volatility, you got a problem with delta, and you got a problem with gamma in those environments. Mm-hmm. Because what happens as the market is going down, 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 when you initially sold that bull put spread, you probably had a 10, 15, maybe max 20 delta. But once it hits your short strike, now you have a 50 delta. And what that means is for every $1 movement on the downside, you're starting to compound that loss much higher because your delta is higher, and then your gamma starts impacting delta even more as it starts getting under that strike sold. And when you're looking at basic credit spreads, I mean, if you're going to get $100 on a credit, you probably have a max of either $500 or $1,000 of potential loss. But the problem is that biggest loss happens when the strike gets in the money. So when you initially sell that bull put spread, you have a range here, maybe 4 ATRs away or whatever the case might be. And as the market starts coming down, you're starting to show a loss, but you're only showing a small loss because your delta is really still small. But once it gets in the money, all of a sudden your compound, that loss gets really, really nasty. And you can't just sit there and look at and be like, okay, I can't do nothing. I have to do something, right? Adding a bear call spread, making those adjustments, rolling the put spread down and out. Or at the end of the day, I think what you said is really, really wise. No, it goes to portfolio design. You shouldn't be putting more than 2-3% into a credit spread in a portfolio. You shouldn't be maximizing anything in a position over 4% in the option market in a portfolio. And that's not just it's not just the position size on one trade. If you have a portfolio designed where you're doing 20-30% in credit spreads, and a majority of those are on the bull put side, you do not have diversification in any capacity. And in moments like this, there's some pain there. So it goes back to the hard. And again, I just think what Noah said was very, very wise. It goes back to the hard portfolio design.
Well,
and
yeah,
I want to add to that because we're talking about different hedging strategies. We are not talking about doubling down. If you're down right now, I would not say, start buying, double your position, start taking riskier trades, because what's going to happen is what Matt just explained on how those deltas and gammas work. If you start taking riskier positions, trying to recover your losses that you made in 2 days faster, and then the market drops again tomorrow, you're going to exponentially lose more money than you already lost.
Well, and let me say one thing to that. When I was a young trader, one of my mentors told me, one of the hardest things to do in trading is just to accept a loss. But it's also one of the most important things you can do in trading is just to accept the loss. And sometimes I feel like, not all the times, there's some really good hedging strategies and management techniques, but sometimes I feel like people are applying hedging techniques simply because they refuse to accept what they see in front of their face. And when the best decision you can do is just take the loss, sit on the sideline, because you don't have to make up the money you've lost in that same transaction. You can wait for the volatility to subside and get back to normal trading. I remember back in, Tyler Craig, the coach Tyler from Tackle Trading, he wrote a blog post in December of 2016 when Trump won the election. And if you guys remember, after Trump won the election, the market was just parabolic for the next month and a half, and just a really good bullish uptrend in that environment. And, those bear call spreads on cash flow condors got beat up a little bit. And I remember Tyler saying, writing this blog, what did I learn from this moment? And his answer was nothing. I took a loss. In the next 10 months, cash flow condors cash flowed every single month. You don't have to be right in every time frame. You have to have diversification of time frame.
That's absolutely right.
That's really good and very important. And for all those fancy words that Matt just used and Cody used, all that delta gamma theta talks about the slope of the credit spread getting steeper and the drawdown and the pain getting bigger as it accelerates. You get past the strike price, really gets steep. And I think that ability to take the loss, Matt, is so important. And this is one of probably my biggest flaw as a trader is I don't like losing. And if I can break even and I can make an adjustment, I oftentimes try to. So I've had to give myself a rule. I limit myself to 2 adjustments and then I have to take a loss. Mm-hmm. And I still have to accept a loss. And then I have to keep that loss above my risk tolerance threshold. So and one of the things I tend to do more is I tend to do more smaller position size, rather than to concentrate into a big, contract position size. Cause then, one trade goes bad. I have to take a, bigger loss on the one trade, but it's easier for me to manage smaller losses on diversified positions. So I'd rather see people doing, 2 contracts on 5 stocks than 10 contracts on just one. Just kind of a general idea.
No, that's absolutely right. It comes down to the trading psychology. And I recently started rereading Trading in the Zone, and it was like the number of things that he points out in there are absolutely true. The market doesn't have any vendetta. It simply presents data. It's your job to take the data the market's presenting with you, manage your own emotions and your own portfolio to be a successful trader. The market doesn't have a vendetta. It's not against you. If you've ever felt it's against you,
the market doesn't know you exist.
Yeah, that's absolutely right.
It can't care about you if it doesn't know you exist. And to answer Mayor's question, what is the message to long-term investors? My message is very simple. Have some perspective. The market's down 7.5% off the highs recently. That was a week ago, mind you. And the market in the last 10 years is up over 450%. So have some perspective in that capacity, and wake me when the S&P crosses the 200-day moving average.
Well, and that's something to really, I think that's important. There's a different temperament in long-term versus short-term. Your long-term.
Why are the long-term so skittish? Because I've seen this on Twitter. I've seen this in social media. I've seen it in our YouTube channel. I've seen it in comments in social media. I
think that might be why they're skittish, just because they see it in all those things you just mentioned. And then they see CNBC, puts up their little flash sign, markets in turmoil. And it gets them emotionally hyped up, where again, it comes back down to investor temperament, and they'll bring on a guy like Warren Buffett right now. Like that's, one of the first people you'll bring on in a market dip, where he'll be like, toe the line, relax, long haul, market recovers, yada, yada, yada. They have to bring on different experts the further the market goes down. And at the very bottom, it's just therapists only. But you start out at the top and they bring out, Warren Buffett will just say things, the market will take dips like this. And this dip really is slightly larger than the last 2 or 3. But it's not any bigger than what we saw back in October.
And I think Stephen has a great question because of 08. There's in this social conscious about, we don't want to repeat of 08. We don't want to repeat of 08. We just recovered. And I completely understand that. And should you sit in cash until you see clearer signs? And I understand that logic 100% as well. But I still believe we're only down 7.5% in the S&P. We're a week away from all-time highs, and we haven't even seen the Fed's response to this. And we just saw what Hong Kong, China, and Germany did with fiscal stimuluses. So can this, get out of control? Absolutely. I've talked about economically how this could impact it many times over the last month. But at the end of the day, we are still only down 7.5% off the highs. I mean, literally, the perspective.
Perspective is really important. Like, and honestly, if you showed me a good couple candles, confirmation on this, that's a steep pullback. So I like shallower pullbacks more. But you can go back and see some previous, steep sell-offs that had sharp recoveries. And I don't doubt that you're not going to see, I don't doubt you're not going to see interference with the PPT and, or, the Feds and quantitative, the central banks throwing money out there. They're going to try to combat that fear.
Listen, with all the fiscal stimulus we put into the market since 17, and with all the quantitative easing we put into the market since 2009, we've created an environment where the higher highs go up faster and the volatility downside happens more. So this is something that we need to understand that's going to impact the market. I said it yesterday. When you have a steep climb in the bull market, when volatility hits, it comes down fast. And if we're going to capitulate as a long-term investor simply because we have 2 days down in the market, and that's going to spark a fear of 08, we're not there yet. We're just not.
No, we're not. Not to any real extent. But all right, let's quickly run through the different indexes, and then we'll move on to crude oil and the US dollar, and then on to the precious metals. But are y'all seeing any major differences between the 4 different indexes?
The Dow, I think, is of interest because it's at the 200 period moving average, and it took, as far as drops go, it wasn't as high up as the NASDAQ and the S&P. Correction, putting it down into the big fat support resistance zone and the 200 period moving average. Matt and I were talking about this on the coach show last night. Yeah, I think this is a really important price area. This 27,000 zone. See, Matt, I did it. I didn't get the number wrong. 27,000.
I'm proud of
yeah, I know. Normally I truncate data. I'm like 2,700. 27,000 is a big price zone. And this is, I think, the type of place where you might see the buy of the dippers willing to step up in this type of a price zone, assuming they get, I think, a little bit of help from the market. You see some upward movement. But if that breaks, I think that one could be dropping to 26 and 26,000 in very short order.
All right. What about
the only other discernible difference? I mean, the NASDAQ is still kind of 1A, S&P 1B. Dow's in a very important area on the chart. The Dow also has a lot of risk to international markets as well. The Russell 2000 is a concern right now, guys.
That's what I was going to say. The Russell 2000 and a lot of our condor traders out there, like this one has probably me the most concerned of all the indexes.
Well, it's also at that 200 period moving average. 1550 is a reasonably solid price zone. Not as big as 1600 or 1500, but it's that 200 period moving average is such a demarcation point for the investor class and for the longer term traders. And if we start seeing more closes below that and it breaks that 1550 zone, 1500 is not a big trip down for it. And the condors traders right now, are probably sweating the bottom side. The nice thing about the condor strategy is you usually have more cushion on the downside. So if you're selling them out of the money far enough, you're still well in your profit zone. So if it stabilizes and stalls here, you're probably okay. But if it breaks down lower, where are your strikes? The sooner you take action on those, the better. And whether it's just closing the trade out early to avoid more pain, or accepting a loss,
or buying back the bear call at a 20% net liquidation and reissuing to offset that.
That's exactly. I've already rolled my calls down. Yep, exactly. That's one of my favorite things to do with that. Whenever the market starts running the very clear direction, I'm usually rolling the options on the opposite side. So if it runs down, I'm rolling the calls down. If it's running up, I'll roll the puts up. But that's a great way to put a little bit of money back in your pocket, and sometimes you can even offset your drawdown. Just depends on how quickly you take it.
Absolutely. Go ahead and move on to the US dollar. I'm, as a Forex trader myself, and I put out a tweet this morning, I'm getting a little excited about the US dollar right now. Because
pretty pullback. You know, Matt and I were on the coach show last night. We were poo-pooing Forex a little bit, and I was thinking about that, Matt. It's probably, we sounded like grumpy old men, like talking about how the Forex market not as good as it used to be back in my day.
It's true though.
Well, you know what? Poo-poo something, but when it's got a nice bullish retracement setup like this, and you can compare that to multiple currencies, and the triggers and the stops are so easy to identify right here. I'm going to tell you that
it's a really clean setup.
Listen,
and
I'm not saying there's not going to be a trade there, right? I do think there's trades there. I just don't think it's a great swing trading vehicle anymore. It doesn't mean there's not going to be setups every now and then. And I absolutely agree with the setup on the dollar right now. It's setting up for a really good bullish trade, and it's setting up for a real good short on the euro. I love the kiss off 109 on the euro. I love it. But those trades have been few and far between.
They have.
In the market.
Yeah. Last month, I said time and time again, both on this show and then on my individual reports, I said, guys, go fishing. Like, go trade the stock market right now. Forex is boring. I was like, it's volatile. It's all over the place. There's not great setups. I was like, go trade the stock market. Whatever market is showing you the setups and the opportunities, that's where you should be trading. Don't try to force a trade in any market.
Yeah,
wait
and
for the
Cody, these markets are cyclical. They do change, right? And sometimes the stock market's really, really difficult. Sometimes it's really easy. Sometimes the commodity market's really difficult. Sometimes it's really easy. Sometimes the currency market's really difficult. Sometimes, well, not lots, but sometimes it can be easy. But to me, I think the currency market has been a much better day trading vehicle than a swing trading vehicle. That doesn't mean there's not going to be good swing trades out there. And I do believe the dollar is setting up as a good swing trade. And I like the ability, even though I'm not an active currency trader any longer, I'd like the ability to go to that market if we see something set up.
And you know what I taught in this past weekend's Forex report? So guys, get over there and check it out. Is I talked about how to day trade into a swing trade if the setup is working, to where you can actually get a better entry price off of something that you did through a day trade and turn it into a long swing trade. And this was one of the examples I used.
You shouldn't watch the replay of the coaches show last night. I'm just warning you.
Just don't watch that. Okay.
Well, I can give you the recap right now. Matt and Noah acting grumpy about how much better currency used to be back in my day. So, that was it.
We'll go ahead and move on to gold.
I'll tell you what, this is a pretty setup.
It's getting there.
It's 3 days down into a rising 9.
Getting there.
Even Mark's gonna have a hard time fighting that one off. So,
well, I mean, we've been touting gold for the entire year, and God, if anyone listened back when we were saying, "Hey, this is showing a reversal pattern," you should be pretty happy right now with your physical metals.
Just wait till the Fed cuts interest rates and starts more quantitative easing.
Non-QE. It's not QE.
Well, quacks like a duck and walks like a duck.
Although, Matt, if you knew that was it Korea that you said was dropping money out of planes? If you knew that was happening, you should have let me know. Hong Kong. I would have flown out there to try to pick up some of that money. Like, I'm a little upset with you for not telling me.
You're not flying to Hong Kong to get $1,200 when you're going to get the coronavirus, young man. But it reminds me of there's an economist by the name of Milton Friedman who basically argued that instead of doing all these crazy QE and Wall Street socialism, all that, just fly helicopters across the United States and drop cash out, and it'll have a greater impact from an economic perspective. And I certainly do have a lot of soapboxes about monetary policy, but I'll save it for the podcast. But
I'm just glad you did.
The one thing I'll tell everybody, the biggest mistake we have made from an economic and monetary perspective is where the money has been funneled over the last 10 years. It has created no velocity to that money, and the GDP of America will never get back to where it needs to be until the middle class is thriving again.
That's true.
That is true.
So you don't want to go into a soapbox on bailing out the banks?
No, and I also don't want to go into a soapbox about how the middle class is thriving right now when they're paycheck to paycheck.
All right. Well, let's move on. Matt, what's going on in the news today?
We got a couple stocks here. Well, first of all, let's talk about crude oil very quickly here. Crude oil is in a moment, Noah. I'm very close. I want to see it close underneath that 49.31 level. We dinged at the low point at right there at 49. No, a short under 49 right now, if we close under.
I'm not opposed to that idea. I like it actually, because it's a pretty good break. And if it breaks 50, that's a huge technical zone. And I think it's got a pretty clean shot to 45.
Well, if you don't know how to trade futures, I mean, you go look at the USO chart real quick.
Very clean setup there.
Very clean
Very
setup
easy
there.
to trade that.
Very clean setup there. So that's the one thing. And one, positive about oil, not really positive, but oil inventories did rise less than expected, gave it a little bit of bounce here. OPEC's going to have something to say in Vienna next week. But this technical chart looks really good with that break underneath 49, a close underneath 49.31, a short underneath the low. That does make some sense here to me. We do have some stocks in the news here to talk about, and I want to get your take on something, Noah. A lot of times when we invest in a company, it's not just that we're investing in the company, but we're investing in the vision and the leadership of that company, correct?
Yeah, absolutely.
Okay. Who's some of your favorite CEOs that you like to follow, track, invest in, so on and so forth?
Well, it used
Justice.
to be Elon Musk. That's a good one.
At all there, Cody.
I've always liked Mark Benioff. I've always liked, Mr. Cook. I've always liked, there's so many of them that again, for me, it's just kind of like coming up with their names off the top of my head.
Yeah.
But I mean, no, strong leadership's a really big deal. I mean, it really is a big deal.
Companies fail because of lack of vision, lack of leadership, and lack of communication. And when you're looking at, like, say, Steve Jobs, right, who unfortunately passed away. When he passed away, we didn't know what Tim Cook was going to do. Steve Jobs was that visionary leadership, and Tim Cook was a marketer. And, obviously, Apple goes down on the news. And then once, the market starts to understand who Tim Cook is and, embraces his leadership, you see something a little bit more powerful. And the reason I bring this up is some important news happened yesterday after we got done with the market halftime report after the market closed. Disney CEO Bob Iger resigns. And Bob Iger has been running Disney for the last 20 years as CEO. And in my estimation, Bob Iger is one of the better CEOs in the world today. His leadership, his vision of what he's been trying to transform Disney into becoming, and to focus on the last 10 years. I don't know a bad decision he's made off the top of my head. I know he was criticized for buying Star Wars for $4 billion. How'd that turn out? I know he was criticized for spending billions of dollars on Marvel. How'd that turn out? He was criticized for spending billions of dollars with Pixar. How'd that turn out?
Do you own that yet?
Well, AT&T.
I'm just. You just throw out any entity. Does he own that one yet? Because they bought up just about everything. Yeah, pretty much.
But you know what? While AT&T is out there spending $92 billion acquiring Time Warner and DirecTV in an environment where everybody's going cheap streaming subscription, services. Here's Disney saying, "Hold my beer, watch this, Disney Plus. Let me go acquire 100% of Hulu from Comcast." Really kind of preparing Disney for the next wave of the future of Disney. And, that's not just traditional Disneyland parks, but digital media through, their movies and the digital media through Disney Plus. And I just feel like, his resignation it's a sad day for Disney because in my opinion, he's a wonderful CEO. Now, Bob Chapek is the head of Disneyland Parks, and he was named the new CEO of Disney, which was a little surprising to me, given the fact that Disney has spent so much time on streaming over the last few years. I thought they would go in that direction instead of the parks. So obviously the market volatility on Disney is going to, come down and down and down. However, I will say this, if you're not an investor in Disney, give me a longer term chart here.
It's going to create a buy opportunity.
120,
that's for sure.
120 is such an important price point on Disney. It was multi-years resistance from 15 to 16 to 17 to 18. That's also right where the 200-day moving average is on a weekly basis. That's catching up to that 120 mark at 113 here. Keep an eye on Disney. Obviously, you never want to catch a falling knife, not from a trading perspective, not from an investing perspective, but keep an eye on Disney at that 120 on the weekly chart. It would not be confirmed on the daily chart. We've got to get some confirmation on the weekly chart, but I'm keeping an eye on that 120 level, Noah.
That's a big level, and I happen to have a line drawn there. It's a big price level. That's you're going to see the support resistance zone play in. You got that 200 period weekly moving average in that same zip code. And again, the beautiful thing about a market correction is it does present opportunities. And we're always talking about, we're concerned about the market being overvalued. Anytime it comes down in price, that does create an opportunity for us.
Yeah, sometimes I hear people say, "Oh, if the market just came to this level, and then when it goes to that level, they're like, oh, but it's coming down real hard." It's just like, okay, have a plan, execute the plan. Next stock in the news here, Space, SPCE.
Can we make some easy rocket jokes on this one?
It's easy to do.
Let's hear your dad. You two are king of dad jokes. What's your dad jokes on this one?
Oh, I mean, it's simple. It's easy. It's taking off like a rocket ship, and we just need to know if it's going to stick its landing.
There you go. I like it.
Houston, we have a problem.
Yeah, that was one of them.
There we go. It's a pretty good looking bull flag.
It looks a lot like Tesla.
But it really looks a lot like Tesla. Let me just do the comparison real quick, just so we can actually show that out there. Well, let's get the symbol right. I'll get these facts.
I don't even know what that was.
TSA?
It's just dyslexia is what it is. So Tesla, double top, hitting the rising moving average, little consolidation, and then Space.
Rising top.
Not that different.
It's pretty similar. And the reason I bring it up is they announced their net loss has widened to 73 million from 2019 of 46 million. But that's not the interesting thing for me. They have 7,957 people registered as interested. Now, they haven't made any money on it because they haven't started taking down payments, but they do have about 8,000 registered individuals interested in taking space flights on Space. And they're starting to take $1,000 down payments. And the only reason I bring this up is for just to ask both of you a question. Are you going to put $1,000 down to go fly in space?
I'd greatly consider it.
What's the estimated cost to really do it?
Oh, it's a lot more than $1,000. That's like $1,000 on a Tesla.
I would be interested in doing it. It would honestly come down to that's something I want to do when I'm in my 80s. Because if it fails horribly, so what? But yeah, I still would do it.
Yeah,
kind of like the great W jumping out of a plane at 90 years old. He was like,
basically.
I have no need to skydive, but you know what?
Bush do a skydive at like 90.
Yeah, that's what I'm talking about. The great W. He jumped out of a plane at 90 years old on his 90th birthday because he was like, you know what? If it goes wrong, I lived a good life.
See, and that's a beautiful thing.
I don't listen to people who say negative things about George H.W. Bush.
No,
absolutely not. No,
never.
1,000 points of light. Read my lips. We're all good.
That was not a very good line.
That was.
Next stock in the news very quickly. Starbucks, Noah, is bringing Beyond Meat to Canada.
Wait, Starbucks is bringing Beyond Meat
to Canada.
20%
of Starbucks' revenue come from their food, not just their coffee. They're trying to enhance their, obviously plant-based as that's becoming more popular. And I'm sure it would be popular with the demographics of people who also like Starbucks as well. So it's going to be interesting, that decision. Not a lot of, impact here, obviously, in the market. Doesn't really care about this type of news on a day like today, but that was just something to keep in mind. And then last, but certainly not least, guys, and then I'll send it out to Cody to send us out for the day, is Salesforce. Well, you mentioned Mark Benioff. Mark Benioff named a co-CEO today in basically that is how a CEO, because two presidents always works, right, Cody?
It's like legging out of a spread. It's really, you're just planning your exit strategy, but you're just bringing in another option.
Yep, and he obviously has an exit strategy. Usually when CEOs like Mark Benioff make these announcements, obviously he started Salesforce.com in 1999 and built it into a juggernaut. If you guys have not heard about Mark Benioff's story, go Google it. It's a really, really cool story. But when you nominate a co-CEO, it's because you probably have some plans down the road to go do what Bob Igor just did and take your cushy little seat on as the director of Salesforce. Like now Bob Igor is the director of the board of Disney. And so you can work on your philanthropy work and the things that you have a passion for. And Mark Benioff certainly has those passions. But they did announce earnings today, Noah, and a beat on EPS numbers at 66 cents versus the expectation of 55. 4.9 billion versus the expectation of 4.8 billion. Revenue was up a really good percent of 34.6% year over year, and guidance was in line. And in a world where we've seen guidance kind of fall, that was positive news for that. I do believe if it wasn't for the situation that we're going through right now, Salesforce would be up right now. Let's see it kind of settle down first. I do think if we do get a pullback to that 165, 170 level, that might be a good reflection point to start looking at it.
Absolutely. I'm really liking a lot of the earnings that we're getting out of here, because even with the market down, I'm seeing more positive earnings. Maybe it's just my cognitive bias seeing that, but most companies are actually taking a longer term approach to really develop out their company. So I'm liking what I'm hearing there. But guys, if you liked our show today and you enjoyed our show, then definitely like, subscribe, follow us every day. We're here every day the market's open for the halftime report. And if you want to understand what our community members understand, and guys, hashtag Team Tackle, let people who aren't Team Tackle members know how great the behind the services are, those reports, the coaches shows, the aftermarket shows, the Wednesday night shows, the women in trading, all the things that you get from becoming a pro member, the community and the actual clubhouse, being able to talk with different traders and get one-on-one interactions, the lounges where you can directly say, hey, I have this trade. Coach, can you help me out with this trade right here, right now? I'm like, yeah, sure. Share your screen and we'll go ahead and adjust that for you. Being able to have mentors in a community like that is priceless, guys. So if you're not a member of Team Tackle, click the link down in the description below, 15-day free trial, or you could always email Mark, team@tackletrading.com, and he'll get you set up. With that, guys.
Hey, real quick, Cody. And guys, let's show up to that coaches show, that Tackle 25 mastermind group today. Noah's going to show you guys how to control the risk to the downside by writing calls and then managing those calls through net liquidation. I remember somebody asked me, what about long-term investors? Long-term investors who understand the options market, they don't freak out nearly as much as people who just park cash in stocks, because they manage it through the writing of calls, managing the net liquidation as the market is going down, and then obviously managing the strike price when the market recovers. So make sure you show up for the Tackle 25 here tonight. Coach Noah, Coach Cody, thank you so much. We're out.